Most investors believe market crashes start with excess. Too much debt, too much speculation, too much optimism. But that explanation is wrong. Crashes don't begin with excess. They begin when liquidity disappears. And when liquidity disappears, markets don't gradually adjust. They cascade. So what actually breaks first? In this video, we'll break down what actually causes market crashes and what investors should watch instead. Debt feels obvious. It's measurable. It dominates headlines. But markets can operate with high debt for years. Debt creates vulnerability, but it isn't the trigger. The trigger is liquidity. Liquidity is the system's ability to function smoothly. It determines how easily assets trade without violent price swings, and whether institutions can refinance their short-term obligations. When liquidity is abundant, credit flows, leverage expands, volatility stays low. But when liquidity tightens, funding costs rise, credit spreads widen, market depth shrinks. No matter the crisis, the pattern repeats. In 2008, housing didn't collapse first. Funding markets fractured first. When lenders pulled back, short-term financing dried up. Institutions that couldn't refinance were forced to sell assets. Selling pushed prices down. Falling prices triggered margin calls. Margin calls forced more selling. That's the cascade. Markets can tolerate excess, but they cannot tolerate funding stress. Liquidity determines when the system breaks. So if debt isn't the trigger, what is? In 2020, earnings didn't cause the crash. A scramble for liquidity did. Even US Treasuries showed dysfunction. Bid-ask spreads widened. Market depth evaporated. Investors rushed for dollars. The Fed intervened aggressively, not because earnings collapsed overnight, but because liquidity broke. Once liquidity was restored, markets stabilized. Every major crash follows a similar sequence. Confidence weakens, lenders tighten credit, funding costs rise, liquidity deteriorates. Leverage becomes unstable. Margin calls accelerate selling. Selling triggers more margin calls. Crashes are feedback loops. And feedback loops require liquidity stress to ignite. Debt makes the system fragile. Liquidity determines when it breaks. Debt is a slow variable. Liquidity is a fast one. Watch credit spreads, short-term funding stress, central bank balance sheet changes, and market depth deterioration. These signals move before headlines do. Understanding liquidity won't let you predict the next crash, but it will tell you where to look when risk begins to build. That's the difference between reacting to headlines and understanding the system. If you want more structured macro breakdowns like this, consider subscribing.